This is Matt Godleski with Stewardship Financial Advisors Investment Committee, bringing you this week's snapshot edition of The Pulse. Here's what we're watching this week. Stocks move higher on continued earnings outperformance and vaccine progress, while stimulus talks move forward but disagreement remains in size and scope, and economic data surprises to the upside. Equities were within striking distance of all-time highs after this week's rally, as technology stocks in particular ripped higher. The major constituents of the S&P 500 reported earnings late last week, with outperformance seen across the board, and the size of those firms enough to boost markets higher. Despite ongoing debate in Washington over the next aid package for the American people, economic indicators came in positively, adding to the risk-on sentiment. U.S. manufacturing grew at the fastest pace since March 2019, back into expansion territory, while applications for unemployment benefits dropped below estimates and continuing claims also fell. At the same time, early reports on hiring showed a sharp slowdown, though prior numbers were revised higher, showing a mixed picture in the rapidly evolving labor market. The bond market continues to express concerns over the economic outlook, with yields remaining subdued and some segments of the curve approaching the lows of March. A major rethink of portfolios is underway given the massive shifts in the macro environment and the implications on interest rates, inflation, currencies, and equity valuations. As with every major financial crisis, the earth has shifted and we must adapt and be prepared for the future. Focusing on inflation, there's an obvious concern that the Federal Reserve and other central banks' efforts to stimulate and stabilize markets with record amounts of money printing could fuel a surge in inflation. In our view, this is a distinct possibility, though in the near term we are less concerned. Once the economy stabilizes and a vaccine is made widely available, an economic rebound could quickly ensue and unleash pent-up demand, potentially driving prices rapidly higher. Perhaps the biggest driver of inflation could be the U.S.-China trade war and other protectionist policies, which effectively deglobalize supply chains and raise prices on consumers. Adding fuel to the fire, the U.S. dollar has begun a decline in recent weeks, clocking in the worst performance in a decade against other major currencies. The implications from this shift, if it continues, would be additional pain for U.S. households and potentially eroding the dollar's status as the world's reserve currency. Interest rates anchored near zero by the Federal Reserve and pressures in demand for yield could keep rates at record lows for the foreseeable future. Rising inflation could stifle the effectiveness of Treasury bonds, with nominal yields close to zero and real yields negative. These low rates translate into cheaper borrowing costs for corporations with great credit, allowing for more shareholder-friendly policies such as dividend expansion and share repurchases. A declining dollar could further benefit many large export-oriented U.S. companies by boosting overseas competitiveness with cheaper dollars. In particular, low rates favor more growth-oriented companies as their discounted cash flows are more attractive than more value-oriented equities. Of course, no one can be certain if rates will remain lower for longer, if inflation will pick up, or if growth may accelerate above expectations. Our thinking for now is the possibility that growth may stagnate, inflation could rise marginally, and rates will remain muted. The implications from this environment could be an increase in the relative attractiveness of cash, commodities, and stocks, and a decline in the ability of bonds to provide a ballast to risk assets. Given the recent run-up in equity prices in the U.S., we have marginally trimmed our exposure to add more liquidity to portfolios. We believe the exuberance investors have shown in the face of lingering chronic pain from the pandemic could be overdone. Our main concern is that unemployment and underemployment will remain heightened through next year, creating a significant drag on consumer spending and therefore the U.S. economy. The argument that investors are looking past 2021 can only go so far in our view. We prefer to be ready for volatility given the extreme potential headwinds in the coming weeks and months ahead. Thanks for watching, and check out our website to read the full version of The Pulse for more details.